今天我们要讨论的呢，是最近这个中美峰会之后啊，全球的格局包括经济走势都出现了一些新的变化。对，然后中国呢是在弱复苏的进程当中啊，房地产市场依然面临着比较多的压力。那韩国呢反而是经济复苏的势头非常的强劲，同时呢，亚洲的信贷市场也开始出现一些分化和调整。
是啊，最近的市场变化确实挺多的。那我们就直接开始今天的话题吧。
好的，我们先来说一下啊。就是最近大家非常关注的这个中美峰会，那这次峰会呢，其实大家都觉得基调是挺积极的。怎么看这个基调背后双方的预期管理和核心诉求呢？
其实这次中美峰会呢，它被明确定位为一个风险管理的事件，就是双方其实在会前的预期都压得非常的低，
对，
然后门槛也设得很保守，但是呢，整体的气氛还是比之前要积极一些。这种积极其实是延续了去年4季度以来的那个趋势。
没错没错。那这次峰会开完之后啊，中美双方到底各自拿到了哪些核心收益，又对未来的竞争格局会带来哪些深远的影响呢？
这个嘛，美国这次主要是在农业啊、能源啊，还有波音飞机的采购上面取得了一些实质性的成果。然后它新开了一些贸易和边境投资的沟通渠道，同时呢，它还是继续把住了高科技出口管制的这个闸门，就是限制中国去获得一些上游的技术嘛。比如说英伟达的芯片等等。
所以美国还是在实体利益和高科技上面守住了自己的阵地。那中国这边呢？
中国这边的话，就是首先我们确立了一个建设性的战略稳定的这样的一个表述，那其实这就降低了突然之间加征关税或者说大规模制裁甚至是沟通完全断裂的这样的一个风险。所以这其实是给我们中短期的这个双边关系带来了更大的确定性。但是就像我刚才说的，虽然短期的风险降低了，但是中长期来看的话，中美之间的这种竞争的格局是没有办法逆转的。
是的，
大家现在就是在一些敏感领域持续的设壁垒，然后在一些非敏感领域可能会有一些有选择的商业合作。说白了就是大家现在芯片和稀土之间的这种供需的依存变成了一个新的相互威慑的这样的一个基础。
原来是这样啊。那我们下面就来说说中国的经济走势。最近这个机构把中国今年的经济增速和通胀预期都小幅的上调了，那这背后到底有哪些新的变化？
其实这次的话，它是把我们的经济增速从 4.8% 上调到了 5.4%， 然后通胀的预期也同步的做了一个上调。那其实主要的原因就是因为我们的出口表现是远超预期的。
是的，
尤其是在 AI 和能源转型的推动下，企业的资本开支是非常强劲的，所以这也成为了一个支撑我们经济很重要的一个力量。
但是呢，4月份整体的这个经济数据出来之后，大家发现其实是低于市场预期的。那主要是受哪些方面的拖累呢？
主要还是因为全球的油价上涨，然后国内的这个消费的意愿还是比较低迷，再加上房地产市场的持续走弱，所以这就导致了4月份的数据整体是低于市场的期望的。然后展望未来的话，我们预计2季度的 GDP 增速大概在 4.5% 左右，上半年的话可能在 4.7% 左右，到了下半年会有一个小幅的回升。那如果说后面全球油价出现大幅下跌，或者说出口压力继续加大的话，可能政府还会出台一些新的财政和货币政策来进行对冲。
了解了。那现在这个房地产市场大家也都在讨论说分化越来越明显，那到底二手房和一手房现在是一个什么样的情况？
就是3到4月的二手房的成交量是同比是有2位数的增长的，但是新房的销售依然是处于一个个位数的下滑，所以其实整个市场的回暖是非常局部的，主要还是因为有很多本来要去买一手房的人现在转去买二手房了。
那为什么今年这个二手房会有一个短暂的升温呢？
主要还是因为春节过后大家的情绪有所好转，再加上去年被压抑的一些需求集中的释放。尤其是小户型，因为小户型可以享受 2.6% 的低房贷利率，比那个商业贷的 3.1% 要低很多，所以这也导致了小户型的成交非常的火爆。
我还想问一下啊，就是从中长期来看的话，有哪几个关键的因素会给中国的房地产市场带来持续的压力？
第一个就是我们的家庭杠杆率已经到了 60%，再往上加的空间已经不大了。第二个就是我们的住房拥有率已经高达 80%， 刚需基本上已经饱和了，所以改善性需求的空间也是有限的。第三个就是我们主要城市的租金是持续下滑的，4月份的租金在短暂的回升之后又开始回落了，这也削弱了房价的支撑。然后第四个就是我们现在7市城新房的库存去化周期已经到了32个月的历史新高，然后二手房的挂牌量也是不断的在增加，超过60%的业主愿意接受 20% 以内的降价，这也说明大家的心态已经发生了很大的变化。
这么说的话，那未来1-2年房地产行业会怎么演变？
其实二手房的反弹很有可能是昙花一现，可能5到8月就是一个非常重要的观察期，一旦这个政策的刺激作用消退之后，市场很有可能会再次走弱。那从开发端来看的话，今年的土地购置面积可能会同比下降 10%到 15%， 然后到2027年新开工面积还会继续的下滑， 所以未来1到2年房地产投资可能还会维持在一个每年 10% 左右的一个降幅。那如果说我们想要去判断这个市场的走势的话，其实最关键的就是要看二手房的挂牌量和中介的带看量，还有就是中大户型的成交有没有真正的回暖，这才是市场真正回暖的信号。
明白了。那我们现在把目光转向韩国啊，韩国最近经济增长预期也是大幅的上调，这背后的主要动力是什么？
韩国的这个经济增速啊，是从原先的 1.8% 上调到了 2.8%， 对明年是继续保持在 2.2%。 那其实这背后最核心的就是半导体的出口爆发。你看它5月份的出口环比是激增了 64.8%， 然后它全年的这个出口增速可能会接近 10%。 同时呢，它的这个非科技和石油相关的一些消费品，比如说化妆品和食品的出口也全面的好转，再加上居民的工资收入是大幅提升的，所以它的消费增速也是从 1.3% 提升到了 2% 以上。那这就说明它的这个内外需是同时发力的。
那韩国的这个通胀和货币政策现在是一个什么样的情况？未来会怎么演变？
韩国今年的这个通胀率是预计会调到 2.5%， 然后2季度可能会冲到 2.9% 的高点。那韩国央行呢，可能会在下一次的会议上面就会释放出加息的信号，然后可能到了4季度就会开始首次加息，一直加到明年的1、2季度，最终的这个政策利率会定格在 3.25%。
那我们下面就来看一下亚洲的这个信贷市场啊，为什么最近这个投资级的信贷利差会持续的收紧，到了一个什么样的历史低位？
因为亚洲的这个投资级的信贷利差已经降到了2013年以来的最低点。
对，
那这主要的原因就是因为债券的负供给，就是它的新发行的债券量是远远小于它的到期量的，所以这就抵消了资金流出的压力。同时呢，再加上股市的高估值也拉低了整体的信用风险。
那接下来亚洲的这个信贷市场会怎么演变？在配置上面有哪些比较好的建议？
到了今年年底的话，债券的供给就会转正了，所以那个时候信贷利差会温和的扩到65个基点。所以我们在策略上面还是建议大家去防御，就是你还是要去选投资级的，然后中国和香港的投资级债券是比较好的，然后也可以去关注一些铜相关的和日元的高收益债但是高风险的投机级的债券就不要去碰了。那如果说一旦出现了极端的能源危机的话，那利差是有可能会扩大到130个基点的。
好的，最后一部分我们就来看一下这个互动问答的环节啊。大家很关心的就是国内的城市租金、韩国的消费和通胀这3个核心的问题，都有哪些比较值得关注的新的观点？
国内的城市租金的话，就是其实现在就是因为就业比较低迷，然后租赁房源又大量的增加，所以未来2年其实租金是很难有一个大幅的回升的。
对，
包括1线城市也很难再出现像香港那样的租金和房价的正循环。然后韩国的消费的话，其实从去年的3季度开始就一直在回暖。那这个主要的动力就是财政补贴，加上股市的财富效应，再加上政治的不确定性消除。同时韩国的通胀的话，是因为能源价格的上涨和内需的复苏是明显的有一个上行的压力的，所以韩国的央行也是已经开始了紧缩的周期。
对，所以我们今天从这个中美峰会的最新的动态，然后聊到了中国的经济和房地产的走势，然后又聊到了韩国和亚洲的一些市场的新变化。其实可以看出来全球的格局真的是越来越复杂，然后各个市场的分化也越来越明显。
没错没错，那这期播客就到这里啦，然后感谢大家的收听，咱们下次再见，拜拜拜拜。
Hello, good morning and good afternoon, everyone. It is May 21st, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this session is for Morgan Stanley institutional clients and financial advisors only. It is not for member press. If you're member press, please log off and reach out separately. Please also note that this session and your questions may be recorded. Today we have Zhipeng Cai, China economist, Stephen Cheng, head of China property research, Kathleen Oh, chief Korean Taiwan economist, and also Calvin Pang, head of Asia credit strategy. During this session, you can send us questions at any time from the Ask a Question text box. Last week we had a US-China summit, and then today we have Zhipeng here to share with us how to interpret outcomes and also the implications on the growth and trade side. Over to you, Zhipeng.
Thank you, Crystal. So maybe I'll have a two-part presentation. Part number one will be on the US-China summit. Part number two is about the economic data that was released on Monday, which surprised to the downside on the broad base. So first, US-China summit. Overall, I think this should be viewed as a constructive risk management event rather than a strategic breakthrough in the bilateral relation. The summit met a low bar going into the meeting, but the tone was positive. There were some tangible deliverables, and both sides extended the truce that they had since the Busan in October, November last year. Now, a lot of clients are asking us, what exactly did each side get from the summit? I think from the US side, the main gains were transactional and more commercially visible, with purchase commitment from China in areas such as agriculture, energy, and Boeing aircraft, alongside the so-called Board of Trade and Board of Investment, which is about communication channels on economic relationship. I think in that sense, I think the outcome is more or less for the US a partial return to the phase one deal framework. It's useful but somewhat limited. And moreover, I think the US also did not appear to make any major concessions on its core strategic tools. For example, the export controls on high-tech industries continue to be a key source of leverage. And even though there was some discussion around the NVIDIA H20 series of chips, I think the broader US strategy of limiting China's access to critical upstream technology appears to be unchanged. So overall, the US gained some transaction, but it also preserved the pressures in its high-tech restrictions. For China, the main achievement was more about the visibility in the bilateral relationship, not just in a few quarters, but maybe in 1 to 2 years. So Beijing coined a new term, constructive strategic stability. I think for Beijing, that matters because it reduces the risk of sudden tariff escalations or abrupt sanction shocks, or worse, another breakdown in these bilateral communication channels, which was the case in the balloon incident a few years ago. And also, as a side, there might be some verbal ambiguity from the US in certain geopolitical issues that Beijing values the most. So if we compare the both sides, I think the US got some near-term deliverables and China got some slightly more medium-term visibility. Looking ahead, we do think that the US-China relationship will remain stable in the near term, but fundamentally competitive over the longer run. The key reason for near-term stability is basically a mutual dependency or mutually assured economic threat. The US still depends on China in the rare earth supply chain, and China also depends on the US and its allies in parts of this advanced semiconductor supply chain. So this chips for rare earth equilibrium basically reduces the incentive for either side to escalate unilaterally and nor aggressively. But this does not mean the relationship is improving structurally. The major friction still points to basically some unresolved issues in export controls, rare earths, or tariffs, investment restrictions, etc. So basically, the Beijing summit created better processes and more dialogues to manage the relationship, but it's not a comprehensive reset. So overall, it's about managed competition. And we do think both sides will maintain barriers in sensitive areas while cooperating selectively in less sensitive areas, especially where the commercial interests overlap. So that's the overall view on the US-China summit in Beijing. Next, turning to the economy. Of course, in the mid-year outlook, we revised up slightly China's growth and inflation forecast. So we're seeing full-year growth at 4.8%. Nominal GDP growth has been revised up to 5.4%. But at the same time, we still think the economy is a very bifurcated one, a two-speed economy, with strong exports but relatively weak consumption. Now, how does the data in April, which was released on Monday, align or disalign with our mid-year outlook? I think basically it's more or less in line. So if we look at the breakdown of the April data, it's in line with the global oil shock, and it's also in line with the two-speed economy. On the oil shock, our view is that it's not just a price shock, it's not just a terms of trade shock, but it's also a volume shock because the Strait of Hormuz situation basically capping the volume that the world is able to consume, and that's why we see that the capacity utilization in a lot of these upstream sectors related to oil turned lower, even in China. And that capacity utilization remains low in May. So the oil shock is clearly transmitting to economic data in terms of lower production volume in the upstream. And then, echoing the two-speed economy, consumption was quite weak in April. not only do we see, all these products in the trade-in program, this year-over-year growth was quite subdued, partly because of the high base last year. We also see that the refined petroleum consumption, it also was down year-over-year in value terms. And that is quite significant because the price of this domestic, refined petroleum actually went up a lot. But still, if we multiply price by volume, you'll see the overall volume still going down, reflecting the fact that Chinese consumers are relatively sensitive to price changes. This is basically in line with our midterm outlook that the consumption and the job market will remain under pressure. And then, of course, there's a housing market drag, which intensified in the month. Later, Stephen will elaborate with a more solid framework instead of just simply reacting to high-frequency data. But basically, the housing investment was weakened significantly in the month, despite some selected and localized improvement in secondary home transactions, showing that the transmission channel from secondary home transactions to primary homes and then to property construction activities, the transmission channel will be very lagged and long in this cycle, which is unlike the previous ones. Of course, we don't think the very weak April data can be simply extrapolated to the entire second quarter. If we look at the past few years, April tends to be the month with the weakest data, particularly if the first quarter data turn out to be very strong. And indeed, I think in the April Politburo meeting, the top leadership's assessment of the first quarter data is that it beat expectations. So usually when that happens, I think the pace of policy easing will be fine-tuned a little bit. And indeed, we see that the government bond issuance has slowed since mid-March. The weakness lasted for the entire of April. And in May, yet a month to date, I think it remains relatively subdued. So policy explained also part of the weakness in data for April, particularly in infrastructure investment, but that it probably will not be the norm throughout the year. And particularly given the seasonality in China's data, May might be slightly better, but for June, which is the quarter end month, there usually will be a quarter end push. And that means the second quarter GDP is probably tracking at 4.5%, around that level, and which means that the first half will be around 4.7%. Now, does that mean we'll be seeing additional policy easing or no additional policy easing at the July Politburo meeting? I think that still fundamentally depends on the Strait of Hormuz situation. To the extent that our baseline holds, that the Strait of Hormuz will start to normalize from the back end of June, and then the global oil prices will gradually trend down for the remainder of the year. Then we think that on the back of this AI and energy transition capex, China stands to benefit. Exports will remain robust, and the full-year growth is on track to reach around 4.8%, meaning the second half growth will be slightly faster, partly on the back of low base. And in that case, we are probably not expecting any additional easing on fiscal and monetary. But if our base case does not pan out and the global oil prices reach demand destructive levels, we will see, probably some global recession weighing on China's exports, and that could trigger some incremental changes in policy. With that, I'll stop here and hand it back to Crystal.
That's very clear. Thanks so much, Zhipeng. As you mentioned just now, there has been some secondary home sales rebound in March. Today, we also have Stephen with us, and then can you share that whether you see this as an inflection point or still a temporary kind of false start?
Yeah, sure. Thanks, Crystal. The housing market in China actually saw unexpected rebound in the secondary home sales volume in March. And in terms of year-on-year, it accelerated further in April. Somehow, in terms of magnitude and in terms of duration, it has strongly beat market expectation. This has led to renewed discussion whether this time is a real inflection or just another false start. Actually, we have done some in-depth analysis in terms of the secondary home sales, and we noticed that there's a couple interesting observations. The first one is if we do a CNY adjusted growth, actually is the home sales in the secondary market was super weak before the Chinese New Year, but it certainly got up significantly after the Lunar New Year. We explained this partially to the pent-up demand relief during the 4Q. As you can see, in 4Q last year, actually the home prices, especially in Tier 1 and top Tier 2 cities, the decline accelerate. This somehow deters the home buyers to do their purchase even they have such demand. But in December last year, the regulators has done a very massive clearing in terms of the social media's negative views on housing. This somehow helped the sentiment recovery, and as a result, the sales has got released after the Lunar New Year when the sentiment pick up. And another observation that we notice is that among the cities, actually there's a very big divergence between the primary market and the secondary market. In the secondary market, while we see a double-digit year-on-year growth in March and April, but on the primary side, we still see a single-digit to teens % decline year-on-year. This somehow explains that there is not a broad-based recovery in the housing market yet, because if we add the primary and secondary market together, actually in terms of volume, it only up single-digit year-on-year. So we believe part of the growth in the secondary market is actually due to market shift from the primary sales to the secondary. So that's why we think that this kind of recovery may not be easily diffused into the primary market like what we observed in the previous cycle. In particular, this time we noticed that the small lump sum housing actually contributes significantly in terms of the total housing transaction volume in the secondary market. And why is that? One of the key reasons is in the past couple quarters when the market heavily discussed about the mortgage interest subsidy, it didn't happen. But the regulators, they did it in a different way, is to enlarge the housing provident fund quota to the residents. But this kind of housing provident fund mortgage, they can only cover the small lump sum housing, but not really the medium or large lump sum properties. So that's why this small lump sum housing, they can borrow at a much cheaper mortgage rate, which is 2.6%. Comparing to the commercial mortgage, which is 3.1%. The 50 bips difference somehow turned this small lump sum housing into positive carry comparing to their rental yield. So this has somehow contributed to the total transaction volume increase in March and April as well. But I think what market concern more is not what has already happened, but what will happen in the future. Comparing to most other sell-side analysts, we actually still hold a cautious view regarding on the sustainability of such sales rebound. In particular, we noticed 4 key drags that may limit the growth or limit the recovery in the sales volume. The first one is is also the most important factor, is that we noticed in the past 5 years, despite we have a big decline in terms of housing sales or housing price, actually there's very limited improvement in terms of household leverage, right? As a percentage of the GDP, the household debt actually is still staying at about 60% of the GDP. Which is very similar to what we had at the peak level in 2021. And also in terms of employment, as most of you are probably aware that the employment PMI is still edging down in the non-manufacturing sector. So that's why we think that at this level, if the home sellers in the secondary market, they can't add leverage for their replacement demand, then the sustainability in the secondary market sales would definitely fade out in the coming months. And also don't forget that in China, we have a very high household ownership, right? I mean, the home ownership ratio in China is 80%, which is the highest comparing to all the major countries in the world. So that's why residents' housing living need has mostly been satisfied, and they can very challenging in terms of adding further leverage. So that's why we think in terms of capability for further upgrading is limited. The second drag in the housing market is definitely on the rental rates. As you can see, in the past 5 years, when we are talking about the home sales decline, actually we also have a decline in the rental rates, especially in the major cities like Hangzhou, Shenzhen, Guangzhou, these cities. Some investors argue that in February, March, we see some pickup in terms of rental rates in these cities, but that is more due to seasonality, because every year after Lunar New Year, there will be some home rental demand from the migrants. So that's why there's some pickup. But in the April data, we already see a renewed decline in April. So that's why we believe if the rental rates cannot stabilize or even trend up, that would add pressure to the housing price, and which would in turn weaken the home sales volume. And the third drag is definitely in terms of the supply side, the housing inventory. As we can see, no matter it's on the primary side or the secondary side, the housing inventory are still very high. Like in particular, the primary side has reached a historical peak, which is 32 months in the major 70 cities that we track. And in the secondary side, the listing volume in some of the high-tier cities has trended down since December. But that is still at a very high level. And also in our March Alpha-Wise survey, when we did the survey asking like more than 2,000 households, majority of the people are still having their home disposal plan, and more than more than 60% of the people, they have the home disposal plan says that they can accept a pricing that is more than 20% below their purchase price. So simply telling you that the home sellers, the secondary home sellers, they're still very urgent in terms of their disposals. And then the fourth key drags would be on the home purchase side. As we mentioned just now, the housing ownership ratio in China is very high already, and most of this housing needs has been satisfied in the urban areas, and residents, they're still concerned about their job and income, and as well as they don't see housing is a good investment too, comparing to the previous cycle. So in our Alpha-Wise survey that did in March, actually it's only a low single-digit % of the residents respond that they have the home purchase plan in the next 1 year, which is super low comparing to the previous surveys that we did. So that's why we think at this time residents, they have a very limited home purchase plan, but the supply side is still very challenging. So together with the declining rental and housing leverage is high, then it's very difficult for this secondary sales to sustain in the coming months. And another angle that echo what Zhipeng mentioned regarding on the GDP is that we see a divergent trend between the primary and the secondary market, right? Currently, the primary side is still declining, and that somehow limit or constrain the developers' capability in terms of the land investment or new start. And if the such divergence continued in the second half, we believe that in terms of the land purchase for the developers this year, it will still be about a 10 to 15% year-on-year decline, and that would translate into another decline in 2027 in terms of new start, right? And together with the decreasing construction scale, which is due to the previous year's decline on new starts, we expect the real estate investment would continue to be at about a teens % year-on-year drop in this and next year. So some of the investors, they also ask what we should closely monitor to see whether there's a real inflection in the housing market. There's a couple indicators that we suggest investors to closely watch out. The first one is definitely in terms of the listing volume in the secondary market, because this is one of the key indicators to show residents' sentiment. Another key indicator that we suggest investors look at is the agency's visitation numbers, because that is the most leading indicator to reflect the housing transaction volume in the coming 1 to 2 months. right? And then the third one is in terms of the transaction mix. As we mentioned in the past couple of months, is mainly the small lump sum housing get transacted, but not really the medium or large lump sum housing. If such transaction mix move up to the medium or even the large lump sum housing, that would somehow shows that the replacement demand of the secondary home sellers are happening. If these three indicators are showing to the positive side, that may lead to a potential recovery in terms of home prices in the second half. But that is not our base case. Our base case is still likely in the coming months. The sales volume would trend down or decelerate in terms of year-on-year. And even if the home sales volume can stabilize in the coming quarters, we believe in terms of the diffusion or the help on stabilizing housing prices, in terms of the timing, the transition timing, it may be longer comparing to previous years or previous cycles. In the 2014 to 2015 recovery cycle, we noticed that after the housing volume recovered for 3 months in Tier 1 cities and 9 months in Tier 2 cities, their home prices would start to turn into positive month on month. But this time, given that we have a much weaker macro, we have a much weaker demographic, as well as the housing health is also much weaker, we believe in terms of the timing for transiting into a positive month-on-month home price recovery, this time it may take a much longer time comparing to the 3 and 9 months in the previous cycle in Tier 1 and Tier 2 cities respectively. So overall, we think that in terms of the sales rebound in the secondary market, we still hold a prudent view and suggest investors to closely monitor the key indicators that we mentioned just now in May to August, because probably May and June will still be somehow masked by those cities with policy easing. As some of you may be aware that in late April, about a dozen of cities, they relaxed their housing policies. So somehow May data or even early June data, it may be like somehow masked by this kind of policy easing. But turning into July and August, which is a traditional low season, if the sales can uphold well in these 2 months, that would have a strong indication into the second half of the year. But so far, we still hold a cautious view and expect the sales volume to turn into negative year-on-year in 3Q. With that, I pass the time back to Crystal. Thank you.
Thank you so much, Stephen. And then next, before we take any questions, I will move on to Korea first. We have seen very, very strong export growth in Korea, and then also there has been faster than expected domestic consumption recovery as well. Today we have Kathleen here. Can you also share whether you see this as sustainable, and also what's the implications on the monetary policy outlook?
Great. Thank you. Thank you, Crystal. Hi, good morning, everyone. So we've published our mid-year outlook on Korea last week. And here we have notably revised our growth and inflation forecast higher. And we turned a bit more upbeat on the Korea's growth resilience this year. Up until March, we'll say we as a regional team were more cautious around the tensions in the Middle East. And of course, the energy prices going higher and potential disruptions to the physical delivery of these raw materials and energy products have had us concerned about these highly export and energy import-oriented economies such as Korea and Taiwan. And there, we had lowered our GDP growth, especially for Korea, from 2.2% to 1.8%. So we had been one of the more bearish houses on the Korean outlook, driven by the Middle East tensions. But as we've seen that the fiscal buffer has been quite a bit of a a shield for the energy price pass-through for Korea. And also, as we see, there was literally very limited disruptions to the export flows and especially the semiconductor exports amid the strength in the AI CapEx activities and the demand for memory chips and prices going higher. We actually have revised our view significantly in terms of the GDP and of course the details of the growth outlook in this latest note. So now from 1.8%, we do see the GDP going higher to 2.8% this year and 2.2% next year. So a bit of a stabilization, but largely still above Korea's potential growth, which is considered to be around 1.8%. Compared to last year's growth of 1.0, this 2.8 would be a significant jump. And of course, the details of it, we previously has thought of argued there would be a K-shaped recovery, and which still does exist. But we do think that not just exports, but also now the domestic consumption, domestic demand, and investment activities are coming around, which should narrow the gap between this K-shaped recovery between sectors and between the expenditure account in GDP between the trade and the domestic consumption. So the export has been doing very well. Of course, the semiconductor export has been doing the heavy lifting. We just got the 20-day export data this morning for May. It climbed 64.8%. And this was mainly driven by the demand for semiconductors. So these customs data does capture the price effects. So in terms of the GDP, we also, when we look into the volume data, we not just the price effects, but we also see the real shipments or the real unit shipments of the semiconductors doing quite well. And we also, in terms of the GDP, have revised the real export growth number to nearly 10% for the whole year. And this is a jump by nearly 30 to 40% from our previous data. And of course, this monthly customs data telling us with the price effects, the demand on the chips would continue along with the story that the AI capex from the US will continue through under our US team's assumption through 2028, at least for now. We also saw not just the tech exports, but more recently, the non-tech export has been doing well also. Our regional team have just released viewpoints this morning where they've been witnessing the non-tech exports recovery taking a faster pace. For Korea, these include more traditional manufacturing goods and capital goods such as machinery, related IT products, but of those with the recent oil price rise, we also saw the refinery and the petroleum product exports also picking up, and those non-industrial exports in the marginal product basis, such as food, noodle, cosmetics, those K-culture related goods have also been a support for Korea. But as a region, we are seeing that there is a clear recovery, not just on the tech side, but also the non-tech goods across non-tech, non-oil exports even across the region. And of course, Korea also has been benefiting that from those in the non-tech, non-oil product bases. We have also recently been looking into the data, and what we are now seeing is that going forward, the domestic consumption, while the trickle-down effect directly from the strength of exports onto the domestic economy might be limited or could take some time, but we also see the bottom of consumption capacity from the households and also the top-down fiscal support for the the household income picture has been turning more positive. We have been seeing some wealth effect as well, which we previously have been looking into a more concentrated benefits to the high-end luxury goods, but we now see a more broader-based effects or broader-based positive consumption driven by the wealth effect as well as the fiscal support in recent high-frequency data. And of course, on top of that, the trickle-down effects from the strong manufacturing activities, we now do see the income data or the January, February wage growth, more specifically when Korea has the bonuses paid out, that growth jumping nearly triple the faster pace than the past 5 years at 12% increase versus 4.45% in the previous years. So we now do see the strength in the consumption a lot stronger than expected. We do think this consumption growth also will jump to above 2% this year from 1.3 in 2025. So again, this narrowing effect of the K-shaped recovery from the strength of the exports to now faster than expected recovery in consumption should bring about the GDP growth rebounding strongly to 2.8% from 1.0 last year. So what this means for the Bank of Korea and the monetary policy outlook? So we do have the BOK meeting next Thursday, and this will be the meeting where the BOK will announce their updated growth outlook since the Middle East conflict had taken place. So their last forecast back in February had not considered the effects of the geopolitical tensions or the higher energy prices. But now after the event has been taking place and the higher energy prices as well as the rebound in the domestic activities have been visibly showing on data, the BOK we think will also will be announcing their revised outlook with higher GDP growth, but at the same time higher inflation, hence turning to a hawkish stance, preparing for a shift towards a hiking cycle in the next 6 months or so. So next week's meeting, of course, the most important aspect would be the announcements of the GDP and inflation data. We do think they will revise the GDP number to high 2% level. Ours is 2.8, and inflation to mid 2% level. Ours is 2.5%. And at the same time, in the dot plot where these the 7 MPC members show their outlook onto the where the rate should be in the next 6 months, we see now the dots to the bottom, as in rate cuts, should be entirely removed, and we would expect 2 to 3 members, so that would be 6 to 9 dots placed in for the rate hike in the next 6 months, based on their higher growth and inflation outlook. So when we're seeing the first rate hike is actually the fourth quarter this year. October is our call for the first rate hike. I think the market has been a bit more hawkish in terms of seeing the first rate hike potentially in the third quarter. Some of the recent changes have been towards the third quarter of taking the spot for the first rate hike. For us, we'll have to, of course, see how the new governor, who's actually coming in for the first time for the policy press conference next week. But he has mentioned that the BOK would look through the first supply shock effects on the inflation just because of the oil, but would wait until the second round effects onto the core inflation and the domestic demand pressure before the BOK would move to a rate hike. So in that sense, we think the timing of the rate hike would be slightly more responsive than reactive timing rather than preemptive one in the third quarter. But we do think next week's meeting, the BOK will just get started to shift its gear by raising their GDP inflation forecast and also making changes to the dot plot before they go for a dissent vote or for a hike in the next meeting in July and August before they hike in October. Our terminal view is 3.25%, so we are seeing 3 total hikes in the cycle. So 25 basis point per quarter for fourth quarter this year and first and second quarter next year. So that would bring Korea's policy rate to 3.25% by end of the second quarter next year. I'll stop here and pass back to you, Crystal.
Thank you so much, Kathleen. And then last but not least, we have Calvin here with us as well. So apparently spreads are tighter for Asia credit. And then Calvin just published his outlook for Asia credit space for the second half this year. And then can you share the drivers behind the tight spreads and also whether you see that it will last?
Yeah, sure. Thanks a lot, Crystal. I think as what Crystal mentioned, I think one of the questions we get the most before our outlook piece is why is Asia credit spread so tight? If you look at Asia IG, currently we are trading through US IG. That kind of never happened since the inception of the asset class since 2013. So I think the short answer why we think it's the case, a lot has to do with this, what we call an uneasy equilibrium that Asia credit asset class is facing. Basically, if you look at year to date, negative supply, if you look at fund flows, it has been negative, but most of those negative fund flows or outflows have been offset by a large negative net supply. So we like to say this is very similar to what the Fed is facing in the labor market, where they have this low hiring labor market, which is an uneasy equilibrium. And I think that's the case, given how large the negative net supply we are seeing in Asia credit, that tend to push spreads quite tight. Another reason driving this tight spread is also obviously the high equity valuations. I think I discussed a lot with our equity team here that if you look at historically, wherever Asia ex-Japan or MSCI Asia Pacific, when it reached a high market cap, usually that correlate with a very low Asia credit spreads. Asia credit spread usually make historical low during that kind of period. And the theory behind that is basically, higher equity valuation tend to mean lower credit risk if you use the Merton model of in terms of looking at debt versus equity. And given that our equity strategies still expect some modest increase in Asia equities, we think this tight credit spread will probably continue. That said, we do think that this uneasy equilibrium will fade a little, given that we do expect supply to turn positive by the end of this year. If you look at Asia credit net supply, two drivers of that. One, we think dollar funding is going to be a lot cheaper versus local currency funding. So if you look at the last 6 months, we've been seeing a lot of pressure for Asian central banks to hike. For example, Katie mentioned that even for BOK, she's expecting 3 hikes in the next 12 months. Yesterday, Bank of Indonesia just hiked the surprise hike of 50 basis points. So what we are seeing is that local currency funding is getting more expensive relative to dollar funding. I think that helps issuers to skew their funding towards dollar bonds, and that should increase supply to the dollar bond market. At the same time, if you look at our Asia Econ team view, they have the structural long-term view of Asia's industrial supercycle. I think that view kind of support that capex for corporates is going to be strong. And if you combine strong capex, cheaper dollar funding, then you usually have strong net supply. So we think that should slightly push Asia credit spread a bit wider to 65 basis points from currently around 55 basis points in the next 12 months. And the reason why is not a lot more wider, obviously, is the high equity valuation we talk about. At the same time, we do think that, for example, Japan dollar credit, we do think that the interest from Japan lifers will pick up here, given their need for higher yielding products in their dollar bond investment. And so far, Japan dollar credit are trading a bit higher than US IG, so obviously offering some pickup. So that should interest Japan lifers to look into it. Lastly, if you look at our bear case, which is where we skew our risk and reward towards to, we do think that in a prolonged energy disruption scenario, which we think obviously have a serious consequence towards Asia, that increased downside risk to Asia growth, which will likely push Asia APAC spread wider. We have around 130 basis point wider target for that. Historically, if you take out COVID period, I think concerns over Asia weaker growth had led to Asia IG spread widening on average about 50 to 60 basis point. So definitely the downside risk is there. And based on the sort of this risk and reward, we do think that given how tight spread is and given the technicals is slowly giving away, we do think that risk and reward favors a more defensive stance. So trades that we like, switching out of high yield into IG, that's one thing we like. Triple Bs to single A, or preferring like China IG over ex-China IG kind of credit. We do think this is attractive. At the same time, we do think that one way to take advantage of our weaker dollar view is to long unhedged, FX corporate bonds. So two places that we like, dim sum corporate bonds and Aussie dollar local currency corporate bonds. We think those are attractive. We also like Japan Bank Senior TLAC and Hong Kong IG. To wrap it up, I think for Hong Kong IG, we do feel like high ball funding has been a lot cheaper, and Hong Kong dollar funding has been cheapening versus dollar funding, and that means that Hong Kong issuers are skewing their funding towards Hong Kong dollar issuance, and that should help spread to be tighter for Hong Kong IG spreads. So why don't I stop here and pass back to Crystal?
Thanks so much, Calvin. And then next we are moving on to the Q&A session. The first question is for Stephen here, which is on the rental growth side. So rents has been very weak in Chinese cities apart from the rebound in March. Do you think that it was driven more by too much supply or weak demand? And then do you expect these drivers to change in the next 2 years?
Yes, as we mentioned in our presentation, that the rental rate in China actually is still in a downtrend, renewed the weakening since April. And I think the key reason behind the two, number one is definitely on the macro side, as we highlight that the employment PMI on the manufacturing sectors are still edging down. This somehow limits the people's affordability in terms of rental. And another reason is also on the supply side. As you can see, in the past 4 or 5 years, actually there has been a lot of this kind of rental apartments introduced into the market. So somehow, together with the secondary home sellers, some of them may turn from sell to rent because of the price has dropped so much. They don't want to take the loss. Then this also increased the supply in the market. So these two factors adding together somehow drag down the overall rental rate. For this and next year, we don't expect the rental rates to see a meaningful recovery or inflection. The key reason is still the weak macro. Yeah, the supply, we don't think this would change too much, but the demand side, unless we see a much stronger macro that improves people's income. Otherwise, I think in this backdrop, likely the rental would trend down further. And in fact, some investors ask whether the Hong Kong's recovery case can be replicated into the tier 1 cities in China, right? Actually, we don't think so. One of the key reasons behind is about the rental. As you can see, in Hong Kong, we have somehow the rental rate edging up month on month, together with the housing price rebound. And that is partially caused by the population inflow from the talents, and this somehow caused the rental the rental yield higher than the mortgage rate in Hong Kong, and that results a positive carry, driving more this kind of investment demand into the market. But the case in tier one cities in China is exactly the opposite, right? In terms of population, we still see some outflow in the high tier cities. And number two is in terms of the rental yield, despite home prices correct more than 40% in the country, we still have only about like 2% to 2.5% this kind of rental yield in the major top tier cities in China, which is still below the 3.1% commercial mortgage rate. So negative carry in China, a population outflow, this somehow like completely different versus Hong Kong. Maybe I stop here and pass back the time to Crystal.
Thanks so much, Stephen. And then we have another question here for Kathleen. Actually, I'll just ask the two questions together. So the first one is that Korea retail sales seems to have bottomed out from last year, third quarter. Was it driven by wealth effect as well? And then also regarding the outlook that you were talking about, do you have any concerns on inflation pressure from the weak Korean won? And then what is your focus on inflation side?
Great. Thanks, Crystal. So on the first question, so we did see the retail sales and especially the department store sales surging from fourth quarter. As our consumer analyst Kelly has upgraded her views on the department store, since I get from them, and their performance has been a fast growth. And we do think partially the wealth effect story is playing here too. I mean, if we just look back to last year, the whole year 2025 story, it was the retail investors were actually net sold, especially the first 2 quarters of the year when we did have the political uncertainty, the new presidential election, etc. It was from the third quarter when the sentiment had been rebounding on the back of the fiscal support. The new government had just pulled the new supplementary budget, and that's when they gave to all citizens the consumption vouchers and cash handouts. And then from the fourth quarter is when we start to see the memory names and the Kospi surging again after Samsung and Hynix share prices go up quite a notable steep pace. So we do think it's a mix of the wealth effect from the fourth quarter and also the sentiment rebound from the political uncertainty from the third quarter, as well as the fiscal support of the cash handout to all citizens in September and November. And our view on the wealth effect, of course, for this year, we do think could be broader than what we had seen back in the fourth quarter last year. We do now think it's not just much concentrated on the luxury high-end goods. But now that we do see the confidence in the local markets have been built for another quarter or two, that the spending pattern and the retail sales activities on, of course, the high-end stores, such as department stores, but also the retail sales goods and services on a broader basis have been picking up more notably, and we have been tracking the weekly credit card data, and it's been actually showing a broad pickup across the sectors and across the services consumptions, which we do think is benefiting from wealth effect, as well as, of course, the income effect that I mentioned from the higher wages, and of course the fiscal support the government is pushing again for the bottom 70% of the income groups for this month especially. The second question on the FX pass-through effect onto the inflation. So we do think the inflation will face much of an upward pressure coupled with the weak won as well as the higher energy prices. I mean, when we do historical analysis, it's almost immediate pass-through when we see energy import prices higher coupled with the weak won together. And we have revised our inflation forecast from 2.1% for the year to 2.5%. And we do see the peak in the inflation touching 2.9% in the second quarter this year. This is based on our Haas view of where we are assuming the oil prices would stabilize to $90 per barrel by end of this year and $80 per barrel next year. So we are working on based on our oil assumption on the de-escalation trajectory on oil prices. And then, of course, the second quarter, we do think the spike higher will materialize. We are looking at 2.89 high 2% headline CPI inflation print for May as well. But the one effect we do think is putting an upward pressure, but we also think the larger concern or more sustainable inflationary pressure could, again, now going back to the consumption recovery story, be on the core inflation and services inflation going forward. So we do think the core will also stay above 2% and drive the more demand pull pressure to be visible in the data in the third quarter, so that the BOK will actually move on to a rate hike by the fourth quarter. So the upward pressure factors from the energy prices, as well as the demand or the consumption side of the story, are putting rather significant pressure on the inflation. But again, we are working on the scenario where the oil prices are going to stabilize downward to below $100 per barrel in the second half of next year.
Great. Thanks so much, Kathleen. So in the interest of time, we'll conclude today's webcast here and then also answer remaining questions offline. Thanks so much for joining us today, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.